Hey everyone, welcome back to the channel, your number one source for income-oriented investing. So on October 6th, I came out with a video called The Great 8 High Income ETFs to Buy and Hold Forever on the Canadian Stock Market. Very popular video. You guys obviously enjoyed it as it has almost 35,000 views. So I'm going to do the same thing, but on the US stock market upon popular requests. So it was actually a lot harder to do the US one than the Canadian one because there's a lot of funds to choose from. So the premise really behind this video, everyone, is I'm trying to tell you my opinion on some of the top US listed funds that you could really buy and hold forever, or positions that or funds that you could consider core or foundations of your income oriented portfolio. So they're gonna have specific criteria, and a lot of the comments from the last video, what about this one, what about this one, what about this one? Well, listen guys, these funds, a top criteria has to be that they're diversified. All right, they're diversified. It's something you could buy and hold forever, something you could consider core position. So obviously in the US, when it comes to income investing, covered call ETFs, the biggest type of fund is an index-based fund, S&P 500 and NASDAQ 100 with covered call. So those are really the funds I'm going to be focusing on today. I've narrowed it down to 11. Now, some of them, like I'll explain in a little bit, are really ideal to live off of. They have it all. They're diversified, their consistent strategy is good, and the distributions are very, very consistent. So they're really ideal to live off. But some of them in the Great 11 don't have consistent distributions, but the returns are so good that I had to include them. So 8 out of the Great 11 are going to be really ideal. They have it all, right? They're diversified, consistent monthly dividends. So there's not going to be much difference between the monthly incomes. 3 of them have more fluctuation with the monthly distributions or weekly distributions, but the returns are so good that I had to include them. So it's not that you can't live off of them, pull the income out every month and live off. They're just not ideal to do so. So those are included as well. And then I'm going to give you a bunch of honorable mentions because there's so many to choose from, and hopefully once you watch the full video you'll understand my reasoning behind it. So let's get to it, everyone. Let's go through the Great 11 funds where I feel you could buy and hold forever. Let's get started. All right, everyone. So the first 6, in my opinion, have it all. You're investing in stocks. It's all equities. They follow a very popular or major index, S&P 500 or NASDAQ 100. Strategy is good. The yields are pretty high, 8% to 20%. But more importantly, the dividends, the monthly distributions are extremely consistent. There's not much fluctuation every month. So these 6, I feel, are really ideal for retirees or people living off the income. They're pulling all the income out. So the first set is the Goldman Sachs ones, GPIX and GPIC. So GPIX with an X is going to be the S&P 500. GPIC with a Q is the NASDAQ 100. So these are what I would consider more, basic ones. These are in the set. The 3 sets are going to have the lowest yields, but you're pretty much sure to capture probably the most upside. They also have the lowest fees. So these are managed by Goldman Sachs. The fees are very, very low, as you could see here. And if we look at the distributions, the monthly distributions, you could see that they're very, very, very consistent, right? They're almost all the same. They're actually going up slightly. So this is a very good sign. So with this one, you could expect a yield of about 8%. GPIC, same exact thing, but on the NASDAQ 100, same fee, same everything. But you're going to expect a little bit higher yield because the NASDAQ 100 is a little bit more volatile. A little bit more tech focused, but again, look at these monthly distributions, very, very consistent. So these are great. These 2 are just fantastic if, for example, you are actually okay with a bit of a lower yield, 8 to 10%, 8 on the GPIX on the S&P 500 and 10 on the GPIC, but you want to capture the upside, more upside of the S&P 500 and the NASDAQ 100. They're going to do less covered calls, obviously. And the fees are low too. So this is really great, fantastic options. The next set is the one from NEO. So you have SPY-I for the S&P and you have QQQI for the NASDAQ. So these yields are going to be a little bit higher. At SPY-I, the S&P has 12% yield, so literally 4% more than GPIX. And QQQI has about 14% yield, also about 4% more. So the yields are higher here. The fees are a little bit higher as well at 68. But very, very, very popular, right? This one, SPY Eyes at 2 billion. And again, this one has it all in terms of, equity exposure, diversification, obviously, because they follow a major index, and very, very consistent monthly distributions as well for both SPY and QQQI. QQQI is a bit newer. It came out literally at the beginning of the year, but it's the exact same strategy they're doing, just on a different index, and obviously it works really well to give you that consistent distribution. So a little bit higher yields here, definitely a lot higher yields actually than the Goldman Sachs one, but definitely ones to consider. The third set have the highest yields. They're from Defiance. These are the target income ETFs. They're actually targeting 20% annual yield. So it's SPY-T for the S&P 500, QQQT for the NASDAQ 100. So these ones, the fees are going to be the highest, 94 for SPY-T and a little over 1 for QQQT. The strategy is very simple. They're doing daily call spreads. You see the spread here, and they're actually holding S&P 500 ETF, IVV, and QQQT holds QQQ. That's why the fee's a bit higher on QQQT, because QQQ, they have to pay the fee on it, which is much higher than IVV. So these ones also have very, very consistent, they actually have to have consistent monthly distributions because they target a yield of 20% annually. You see that here in SPY-T. QQQT a little bit newer, only 3 distributions have been declared, but same exact strategy, daily call spreads with a 20% annual yield target. So between these 6, everyone, I feel like they have it all. In terms of performance, in terms of the S&P 500 ones, believe it or not, SPY-I is the one that's lagging the most in terms of performance. GPIX and SPY-T pretty much have identical performance. You'll be very, very surprised. So in my personal opinion, I would, out of the 3 S&P 500 ones, I like SPY-T the best. It's performing really, really well. It has the highest yield. Obviously, this strategy works really, really well. So I think Defiance, in terms of this category where it has it all, consistent distributions, SPY-T would be my choice, my favorite one personally. But hey, that's just me, everyone. There's no right or wrong. GPIX is good with the lowest yield, captures a lot of upside, good return. SPY-I, a nice juicy 12%, really in the middle when it comes to the dividend here between GPIX and SPY-T, but it's actually not performing as well as the other two. And I'm not going to do the performance for everything. Go on this website. It's a very good website. You put the stock symbols and you could compare 2 of them. So you could put, GPIX, for example. I'll just do it now, versus SPY-I. You could see that SPY-I is lagging GPIX. I won't do it versus SPY-T because SPY-T and GPIX are almost the same. So you could see quite a performance gap with SPY-I for some reason. But it's actually the opposite for the NASDAQ one. So when it comes to GPIC versus QQQI versus QQQT, QQQI is the winner in terms of total return. And again, you could do the return comparisons for yourself. So I would say the best of S&P 500 out of the 3, in my opinion, the one I would prefer, let's say I'm retiring and I'm living off the income, it would definitely be SPY-T. And the NASDAQ one, it looks like QQQI is really the one that's working. It looks like Neo's strategy is working really well. A lot better on the NASDAQ than the S&P 500. And you kind of see that with different funds, right? The QQQTs, it seems like this strategy that they're doing, not as good as the S&P, right? So these are the first 6 guys. These are all S&P and NASDAQ. They're diversified. They all have very, very consistent dividends. And I separate it into 3 sets. You got lower yielding ones with the lowest fees. You got the Neos ones in the middle in terms of yield. And then the highest yields, they target 20% would be the Defiance one. So it's up to you which ones you want to choose. Let's move on. Now, the next 3, they're also S&P and NASDAQ. However, the only reason I didn't include them in the first category is because the distributions are not consistent. But I would be crazy to leave out QDT and XDT and even iSpy because they have phenomenal performance. So QDT is NASDAQ 100 covered call ETF from Roundhill. XDT is the S&P 500 covered call ETF from Roundhill. So QDT and XDT, they have very, very high performance. So QDT in terms of total return is beating everyone. It's beating GPIX, QQQI, QQQT. You guys know that this is the fund I have on drip in my retirement account. So this is very interesting because both XDT and QDT have weekly distributions, but they're really not consistent. That's why they're not in the first category. That is really it. So it doesn't mean you can't live off them and buy and hold them forever, but you just got to expect big swings with the distributions on a weekly basis, and it's based on volatility. The higher the volatility is, the higher the distributions are. The proof is in the pudding. August was a pretty volatile month, and you see how huge the distributions are. Now volatility is relatively low. It was very low in the last week, and you could see a very low weekly distribution, right? 20 cents, 31 cents, 26 cents. So it's not a crazy fluctuation, but I would say it's a significant fluctuation where it could be hard if you're looking for consistent dividends. But in terms of total returns, these are the best. Not only that, they're actually beating the indexes. So XDT is actually beating IBV, VOO, and the SPY, and QDTE is beating QQQ and QQQM. I showcased this in my latest video called the Holy Grail video, the Holy Grail of income investing. These were featured. So iSpy also has to make their grade 11. It's in the 3 that don't have consistent distribution. So this one is actually in second place in terms of S&P 500 performance. Second place to XDTE. Very, very high total return. Again, guys, feel free to use the dividend channel to compare the funds here. It uses daily options like SPY-T and XDT, but it's definitely the one with the lowest fee that uses daily options, which is not a surprise. It's ProShares. It's the biggest fund manager out of all of them. And they also have a NASDAQ one, but the NASDAQ one, I'll talk about it a bit later as an honorable mention. But here's the distributions, monthly distributions. You could see that they're not consistent as well, but I just had to mention this one for sure. It's definitely part of the grade 11 because the returns are absolutely phenomenal. So in case you really don't mind distributions that are not consistent, these 3 out of the 11 or out of the S&P and NASDAQ ones have the highest performance. So these ones, if total returns is way more important to you, then these 3 are definitely ones to consider, everyone. So the last 2 are, I would say, not really equity. They're in more an fixed income or alternative, but they're great anyway. I got to mention them. SVOL is one of them, part of the grade 11 for sure. So if you're, this is good if you want really boring stuff. If you want fixed income, SVOL is becoming more and more a fixed income ETF, in my opinion. But they still have that VIX short strategy, so it's kind of an S&P 500 with fixed income. It's a bit of a hybrid. So if ever you're looking for your retiree, you want to live off something, you want to add fixed income, SVOL is my top choice for sure. It has a very high yield of 15% plus, huge fund, over 1.2 billion. Returns are good as well. Yes, they recently lowered their monthly distributions from 30 to 28 cents, but that's because it holds a lot of fixed income, including a lot of short government bonds, which when the Fed reduces the interest rate, you get less income. So SVOL has been generating a little bit less income if interest rates go down. That's why they had to reduce the distribution a little bit, and I wouldn't be surprised if they have to do it again. But still, 15% yield, guys, absolutely no slouch. And as you could see, these are ETFs that they hold in the fund, and a lot of them have to do with fixed income, right? Aggregate bond. This is kind of like, this is short-term government bonds, high yield bonds, mortgages, national mini bonds, municipal bonds, intermediate bonds. So this is a great fund if you want to live off, you're pulling the income every month. It's very, very consistent still, very high yield, and you get some fixed income exposure here. Last out of the grade 11 has to be CEFS ETF. So closed-end funds are very popular, everyone, on the U.S. stock market. I talked to Steve Bavaria about them. In my opinion, there's so many of them that the best way to get access to them is an all-in-one. And the best all-in-one ETF, this is another cool thing. This is actually an ETF. It's an ETF that holds a bunch of closed-end funds in the U.S. And it's managed by Saba, a closed-end fund expert. So even though this one has a management fee and acquired management fees because they're holding other funds, their performance is so stellar, it's so good. I gotta be crazy not to include it in the grade 11. Look at this insane performance, and this fund has been out for quite a long time, guys, over 5 years. Over 12%, 12.5% average annual is really good. Since inception, over 11. Look at the 1 year performance, 38. It's literally beating it's beating everything in the last year. So it's very, very obvious that these guys know what they're doing in terms of closed-end funds. The yield is a little low at under 8. They actually haven't changed the monthly distribution in a long time. I would love for them to increase it. So it's definitely the lowest yielding, but this is just a great option if you want to get into closed-end funds. You like closed-end funds. You just don't want to pick and choose them. They do it for you. The returns speak for themselves. You could see the list of all the closed-end funds they have. So, of course, a big chunk in BlackRock ones, and they're basically hunting down closed-end funds that are trading at discount, guys. So within this fund, within this ETF rather, you have a whole mishmash of all kinds of stuff. You have fixed income, all kinds of stuff within the fixed income world. You also have stocks, equities, for example, BIGs, all technology equity. So you really have a huge diversification here. And again, this is the theme of this. You know, they all have to be diversified. This is something you could buy and hold forever, and you don't have to worry. So that's why a single, Coney and a yield max single stock like MicroStrategy is not going to be here, guys. These are supposed to be core positions. So these are the great 11, in my opinion, right now on the U.S. stock market. There is a bunch of honorable mentions. You're probably wondering, where the hell is JEPI and JEPQ and other stuff? Well, let's get into it. Let's go through a bunch of honorable mentions now, everyone. These could also be, I guess, considered great, if you will, buy and hold. And again, let's go through them, and I'll give you my reasoning why. And by the way, if you haven't already, please hit the like button, like and subscribe. I would really appreciate it. I know many of you forget, including myself, to like. So why is the two biggest ones not part of the grade 11? Why are they only honorable mentions, JEPI and JEPQ? Well, it's very simple, everyone. It's because GPIX and GPIC, I feel, have the upper hand on them. GPIX, I feel, is better than JEPI. GPIC is better than JEPQ. For the simple reason that JEPI and JEPQ, they're not the entire NASDAQ 100. JEPI is not the entire S&P 500. It's actually stock picking within. And it basically, they underperform the Goldman Sachs ones by a lot. So if you do JEPQ versus GPIC, you see that there's a pretty significant, well, not that significant, 32.79 to 35.37. But another thing is JEPQ and JEPI don't have the consistent dividends that the Goldman Sachs ones. So not only do they not have the consistent dividends, they're underperforming as well. But hey, if you really are a defensive investor, I guess these ones are good. Also, they're very, very big and popular. JEPQ I like a lot better than JEPI. If we do just JEPI versus GPIX, the S&P 500 one, there's even more of a discrepancy with the performance. So JEPQ I like better than JEPI. You heard me say before. So this is why they're honorable mentions and not part of the grade 11, is because there's literally something better in with the similar yields, but better performance, more consistent distributions as well. The next honorable mention, really, really good fun, guys. It's Bali. So this is actually, I find, a better version of JEPI. So this is stock picking within the S&P 500. You see the fees, 35 basis points. The returns are just really good on this one as well. They pretty much are identical to GPIX, actually, even a little bit better than GPIX. The only thing that it doesn't have is the consistent distributions as well. So definitely an honorable mention if you rather have stock picking instead of within the S&P 500 instead of the S&P 500. I would always get the S&P 500, but the returns are really, really good. I gotta give a shout out to this one. Definitely superior to JEPI in terms of total returns here with about the same fee, but no consistent distributions. Has to be definitely an honorable mention, everyone. Another honorable mention is the ProShares NASDAQ daily one, IQQQ. The reason why this one's an honorable mention, not part of the grade 11, is the performance is not as good as QQQI. So compared to the NEOS one, right? So the NEOS one is outperforming it with a higher fee, and it has consistent distributions, and IQQQ doesn't. So it's still good, right? It could still be one to choose from for your NASDAQ 100 exposure, but this is why it's an honorable mention, is because it's not even beating QQQI, and QQQI has not only higher performance but has the consistent distributions, where IQQQ, just like iSpy, does not. So essentially what I'm trying to say is the just like the SPY T versus the QQQT, the I Spy ProShares, the S&P 500 one, the strategy seems to be working much better on the S&P than the NASDAQ. But hey, still good. Still an honorable mention. Next honorable mention is IVVW. So this is the lowest fee covered call ETF ever. 25 basis points, even lower than GPIX at 29. Bali and JEPI and JEPQ at 35. 25 basis points. This is a rinse and repeat strategy. This is probably going to perform best when the market's flat or down because it does 1% out of the money monthly calls. So it's fairly aggressive. It gives up a lot of upside. It's only pretty much capturing 1% a month upside of the S&P 500. The yields is pretty high, of course, because they're collecting a lot of premiums. But the distributions, I don't know why it's spinning right now. Super annoying that it's happening right now while I'm filming this. Let's try it again. There we go. Distributions are very, very inconsistent. So that's why it's an honorable mention. Not part of the grade 11, but still, if you're, this is great for a skeptical investor that thinks the market's going down or flat. This is a good one to hold. Very low management fee, the lowest. That's also a big plus. But if we just do IVVW against SPY-T, for example, you see SPY-T is beating it. GPIX is beating it as well. So in terms of performance, it's not the best. But of course, it's normal because we're in a bull run. Right, so IVVW, if you're writing more calls and there's a lot of upside, you're giving up. But this one is definitely an honorable mention and one to look at because if the market starts going flat or down for a long period of time, this one's going to start outperforming, especially with the low fee. But inconsistent distributions. The next one, T-SPY, is actually the highest performing one right now for S&P 500. I just didn't include it in the grade 11 because it's really brand new. So if you do T-SPY versus the top performing S&P 500 cover call ETF XTT, it's actually beating it by a tiny bit here. So this is definitely an exciting one. We got to keep our eye on. Do some research on this. This one uses daily options as well, and I know they have, or daily spreads, I believe, and they do have a Nasdaq and Russell 2000 one coming out soon. And for a daily option, I find the management fee is pretty good. It's actually identical to the NEOS ones. It's growing pretty rapidly. This distribution yields nice and high at 14. Let me just check how many distributions did they declare. I think just one. Yeah, just one. So it's very early to tell, but definitely an honorable mention, something to keep our eye on. I'll definitely be watching it, monitoring closely. Last but not least, another honorable mention is GIAX. This is the only one that I found that actually is global exposure, right? So been talking a lot about the S&P and the NASDAQ, but this is actually global and it's very interesting. They do daily spreads on a bunch of indexes. So if you look at what it holds, it actually holds the S&P, the Russell, the Vanguard Dividend Appreciation ETF, which is a dividend ETF. I believe it's VIG. They have a FTSE Developed ETF. So this is going to be things like Europe, Australia, Japan. They have QQQ, and they have a bunch of other little things like Argentina and India, and even some single stocks. So it looks like this one is really, just like the name says, gives you global exposure. So if someone is interested, look, I want the whole world. This is really the first one I found in the US. It is still relatively new. The yields are really, really high. I think it's like 24% yield based on 2 distributions declared at 40 cents a month. So definitely want to keep our eye on the returns. If we just compare it to SPY-I, which is the lower performer of the S&P 500, you see that it's not even beating SPY-I, but of course it's only been not even a couple of months that it's out yet. So I'm definitely including this one as an honorable mention because of the characteristics that it's global. But return yield is impressive, fees okay for global, right? It's going to be definitely higher. They also have to pay the fees for the ETFs inside here, which cost something. But yeah, in terms of performance, not that impressive. We'll keep our eye on it. It's not even beating the S&P 500, but typically, guys, something global never beats the S&P 500 anyway. Last of the honorable mentions, I know people have been probably yelling at me, what about the Russell 2000? So I decided to exclude the Russell 2000 from the grade 11. That's just my opinion personally, but I put them as an honorable mention. So Russell 2000, yes, could be definitely a core foundational position of your portfolio. I like the Russell 2000, but it's small cap. it's a little bit risky, but you're getting the Russell 2000, you are getting diversification. So I guess it meets the criteria. I just decided to stick with big cap for the grade 11, but let's mention the Russell 2000, everyone. So there's a few to choose from. You got the NEOS one, which has 14 to 15% yield. You have the lowest fee one from iShares. And this is basically the same thing as IVVW, the exact same thing, but it's the Russell 2000 and it's 2% out of the money instead of 1% out of the money. So this is a good one as well if you feel the market's going to go down or is going to be flat. Very, very high yields as well for this one, just like IVVW. But I guess because the Russell is more volatile, they decided they could go a little bit more out of the money, 2% instead of 1%. You have RDT as well, XDT and QDT's brother, and you have the one from ProShares, ITWO, which is very, very new. They haven't even declared their first dividend. So all four of these can be good. They can be cornerstones of your portfolio as well if you like the Russell 2000. Myself, personally, I'd rather go with the big cap, but I got to give a shout out to a couple of these Russell 2000 ETFs. So I'm out of breath now. Let me drink some water. I hope you appreciated this video. Again, this is my personal opinion. Maybe you like some better than others. Maybe I didn't include some on the list. Let me know if you feel I excluded any. And again, make sure we're talking about diversified funds here. You guys know that my favorite way to invest is index investing with covered calls. Hopefully we get some leverage options soon, everyone. That's what I think is coming next, or what needs to come next for the US covered call market. So give me a thumbs up. I really appreciate it. Let me know what you think. Hopefully this video was informative for you, and see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.